Right, once again, good evening. I will record this lesson so that others may have access to our lesson. Right, we are introducing our new topic, which is investment and security. This is our paper 2 topic, where you will find it in paper 2, that is for our June exam and also prelim. We will begin by focusing on terms and definitions. Terms and definitions. Terms and definitions. The first term or the first word which we are going to define is investment. That is our term number 1. What is the meaning of the word investment? That is our word number 1. Right, when we are to focus on this term, we have to understand that people invest for one purpose, so that they may get returns. So investment is a process of investing or saving money in order to yield or give better returns. But there is a missing word there, where we have to say in order to give or in order to get better returns. Take note of that. So whenever you spend your money, you open a bank account, you are investing because you are going to earn interest. Or you buy shares, it's a form of investment. You will also get dividends. Those are the examples of returns which you may get. All right, Bonolo, you can ask your question. Unmute and ask your question.
Oh, yes, sir. I wanted to ask if there's a difference between bank investments and fixed deposits.
Kindly ask your question.
Sir, I wanted to ask if
I
there's
saw
a difference.
your hand up. You
Sir,
raised your hand.
Sir.
No question. Okay.
Hi, sir, I have a
Let us
question.
proceed then. Right. Maybe if you can't, or if you don't have the ability to use your mic, you may use the chat box for the questions. But let's go to word number 2, which is JSE, Johannesburg Security Exchange or Stock Exchange. The definition of this must include the word formal. JSE is a formal market, which is for trading, that is buying and selling of shares. If you want to buy your shares, you go to JSE. So therefore, we say it's a formal market trading in shares. It comprises of all public limited companies, Private companies are not allowed to sell shares through JSE. It's only public companies. And also not all public companies, but the listed public companies. So when you see this term JSE, remember that we are referring to a formal market trading in shares, that is buying, or it is a market or a place where we can buy or sell shares. Only public companies can buy or sell shares. And remember that I emphasized on this word listed, meaning to say only companies which are listed there, only public companies. Some public companies are not listed, therefore they are not allowed to sell or buy shares through JSE. Right, then the next term is share. What is a share? A share is a stake of ownership. It is a stake of ownership representing the money which you have invested in a company. Therefore, we say it gives an investor the opportunity to obtain a part ownership of a company. If you buy shares, maybe you buy 10% shares of maybe Curo, you become a shareholder. Therefore, when they share or they distribute dividends, you are going to be given your percentage depending on the amount which you invested. So share represent a stake of ownership or part of ownership of a given company. You are a part owner of that company. You are a shareholder. Then the next word is capital market or security market. Okay. Right. Your question is about, can fixed deposits be part of investment? Yes, fixed deposits are part of investment. That is correct. Fixed deposits are part of investment. We will discuss about them when we are now focusing on investment opportunities. As long you are having fixed deposit, you are supposed to earn interest. That interest is regarded as return or returns which you get from your investment. Though fixed deposits are not forms of investment which may allow you to earn more returns compared to shares, but they are still regarded as a form of investment. But let us move to another term. Oh, sorry, let me continue. I'm focusing on capital market or security market. This is a market where we buy and sell securities. When we are referring to securities, we are referring to shares. When you buy and sell shares, you buy them from capital market or you can sell them capital market. An example of capital market is JSE. That is our example of capital market. That's where public companies or government-owned companies can raise funds through selling shares. For example, Curo may sell shares through JSE. They are raising capital, which is long-term capital. Then another term is short-term investment. Short-term investment, we are referring to any form of investment which may be done for a period shorter or less than 1 year. That is a short-term investment. You're investing for 6 months, you're investing for 1 month, 2 months, as long it is less than 12 months, it is a short-term investment. Then the opposite of short-term investment is long-term. Long-term investment, you are investing for a period longer than 1 year. You are investing for a period longer than 1 year. It's greater than 12 months. Therefore, you are earning returns, you're earning dividends, or you are earning interest for a period which is greater than 12 months. For example, if you open your fixed deposit account for 2 years or 3 years, it becomes a long-term investment. But if you open your fixed deposit account for a period less than 12 months, maybe you opened it for 6 months, it becomes a short-term investment. Right, then let's go to another term, which is fixed rate. Fixed rate, it means you are earning interest. That interest will stay the same. It will stay the same for a period. If it's 12 months, each and every month, you are earning 10% interest. It does not increase. It doesn't increase. It remains the same. Then another term, it's accumulated. The word accumulated, it means you are earning an interest over a given period of time. For example, if you invested for 12 months and you are supposed to earn 10% interest, or sorry, if you invested for 2 years and you are supposed to earn 10% interest per year, you are going to accumulate interest of 20%, which is 10% per year. 10% multiplied by 2 will give you the accumulated interest over the investment period of 2 years. Then some investors may opt to earn simple interest, while others choose to earn compound interest. So these are two types of interest. which you may earn as you are maybe investing somewhere or in a bank under fixed deposit or depending on where you are investing. Those who are doing maths lit, I think they've studied or the teacher taught them how to calculate simple interest or compound interest. Right, we will discuss about this in detail as we go further, but by definition, we define simple interest as an amount of money generated or return generated by an investor, and it is calculated on original principle. It is calculated on original principal amount. Then the compound interest, it is calculated each period on original principal amount, including interest accumulated. I will clarify on compound interest. On compound interest, it means you are reinvesting. The interest you are getting, you don't take it, but you reinvest. Therefore, your principal amount increases. It won't be, it will not remain the same. If you invested 100,000 and you are earning 10% interest, following year, you'll be now having 110, meaning to say you reinvested the interest you obtained or you received in your previous year. So the word compound in this context means reinvesting your interest. So your principal amount will be increasing each and every year. So we'll discuss about this in detail when we go for calculations. Let's go to the last term, which is risk. There is no investment without risk. As you are investing, you may lose your money because of different forms of risk. Risk can be high or low depending on the state of the economy. Right? The term risk is defined as a chance that invested amount may reduce in value. For example, you may invest or you may open a fixed deposit account. And then because of inflation rate or high inflation rate, your amount of money which you placed in that account may reduce the value. Meaning to say the nominal value, it may be high, but in terms of buying power, it may be low. So therefore, that is the risk of losing money, especially when you are earning interest, which is less than the inflation rate. So the risk happens depending or occurs depending on the state of economy. Think about people who bought shares some time ago. Their shares, instead of them accumulating value, but they decreased in value because the companies are not making profits. Now, in that situation, if the value of shares are decreasing, it means you are experiencing or you are being affected by the risk. You are being affected by the risk. Right, let us move to the next slide. In our next slide, we are focusing on functions of JSE. Functions of JSE. We all know JSE as a formal market where we can buy or sell shares, or where public companies can buy or sell shares. That's how we defined JSE. Now we want to focus on the functions of JSE. One, that is function number one. It raises primary capital by encouraging new investment in listed companies. For example, Curo as a public company, when they are intending to raise capital, they will sell shares. Then new investors will come and buy shares. When new investors are buying shares, Curo is raising capital. Therefore, it can expand and open more schools. Then function number two, it gives opportunities to financial institutions such as insurance companies or banks to invest their funds in shares. For example, we have Asupol or Asupol as an insurance company. My Way as an insurance company, they collect premiums each and every month. Your parents are paying premiums for the policy which protects their cars. So what happens is that when Asupol or My Way collects funds from clients, they don't keep that money. They will go to JSE and buy shares. so that they may accumulate or earn more interest. They don't just keep money which they collect from the clients, but they go to JSE, which is our market, then they buy shares. Right, another function, that is function number 3. JSE serves as a barometer or indicator. The word barometer simply means indicator, an indicator of economic conditions. For us to know that the economy of South Africa is performing well, we may go to JSE and observe the prices of shares, the prices of securities being sold there, the prices of the currencies, the rand against the US dollar. We observe the prices. If the prices are increasing, let me say the prices of shares are increasing, it means the economy is performing well. If the prices of shares are decreasing, it means the economy is not performing well. Similar to the currency, if the value of rand is appreciating, it means the economy is performing well. If the value of rand is depreciating, the economy is not performing well. So those are the indicators which we get from JSE as we are observing prices. I think each and every day when you are observing or watching TV, they tend to publish the prices or the information about JSE. Please observe the prices, then you can tell the performance of the economy. Is it favorable or unfavorable? Depending on the prices, whether they are increasing or decreasing. Also depending on the value of rand against the other currencies, whether it is the value of rand is appreciating or depreciating. Right, let's move further. Another function is that JSE keeps investors informed. If you are an investor, you must always observe the information published by JSE, the prices published by JSE. You can see the prices if they are decreasing or they are increasing. Then you can have a chance to buy at a lower price. Then you can sell those shares at a higher price. There are people or brokers who are into business of buying and selling shares. They are always observing the prices. Therefore, JSE keeps them informed by publishing the prices of shares daily. Now, it allows them to know when to buy shares. They buy shares today because the price is depreciated or the prices went down. They wait for an economic condition which is favorable, then the price of shares appreciate, then they can sell, then they get profits. So all investors are informed by JSE. Then another function is that JSE acts as a link. It acts as a link between investors and the public companies. A link, it means that is a part or a place where these two parties meet. The public companies are the sellers of shares, while investors are coming to JSE to buy shares. For example, if Mr. Ndlovu wins lotto, he gets some millions, he may decide to go and buy shares. So I will meet a public company which is selling shares in JSE. I will go to Curo being the public company, then I buy shares. So where did I meet the public company? That is at the market, JSE. Right. Another function is that shares are valued and assessed by experts. Shares are not just being sold, or you don't just decide in terms of the price of your shares as you are selling shares. JSE is having experts, people who are knowledgeable, who decide. They assess also how much can your shares be sold. Then another function is that small investors are invited to take part in the economy of the country through buying and selling shares. Shares are very affordable. You can buy any number of shares. You keep on increasing them slowly each and every day or every month or every year. So small investors, people who may be low income earners, can buy shares at a small amount or at a lower price. So investors, or this term for investors, we are not talking about only Patrice Motsepe, the billionaires or millionaires. Also, we talk about the Ndlovu, the low income earners. They can buy shares. but they can buy small percentages, which means they are being accommodated by JSE. Then also JSE serves as a venture capital market. Venture capital market is made available on the open market, where if you are intending to raise capital so that you expand your business or you venture into other business, you can sell shares through JSE, which becomes an open market, which allows the buyers and the sellers to meet. Right. Another function is that JSE is an order market for securities. It is an order market for shares, and it serves as a disciplined market for securities. There is order in JSE. You don't just buy and sell, but you follow the requirements, you follow the rules and regulations. That is why we say it is an order market for securities. It also mobilizes funds for insurance companies. As I said earlier on, when I was explaining point number 2, I said insurance companies such as MyWay, Asupol, or all insurance companies in South Africa, they collect premiums from their clients or customers. Then they have to invest. They don't just collect and keep money. They will go to JSE and invest. As they are investing, they earn dividends from shares. Then JSE also regulates the market for dealing with shares. It regulates the market through establishing the rules and regulations, whereby investors, when they are buying shares, they have to follow those rules and regulations. JSE also plans and they research. They plan about how people are going to sell and buy shares. They also conduct research on behalf of investors. Then they distribute information or they advise investors on what to do, where to invest, and how to invest. Maybe, for example, before you buy shares from Curo or from any public company, from Standard Bank or from FNB, you may get advice from JSE. Whether is it suitable for you to buy preference shares? Is it suitable for you to buy ordinary shares? They will advise you about the types of shares which are better or are having less risk, or they are also high paying, and so on and so on. JSE ensures that the market operates in a transparent manner. When we mean transparent manner, there is no information hidden about the shares, the prices, and how will you pay when you are paying for your shares, and the certificate which you're going to receive. Every information is transparent. It is not hidden. Also, JSE provides protection. It provides protection for investors. Remember, you are dealing with money maybe in millions or billions. You need to be protected. There are people who may be selling shares which are not existing. They can scam you, especially if you are not being protected. By in that situation, JSE protects investors. They don't just allow funny companies or unregistered companies to just go and sell shares. They first scrutinize, they assess the company, then they will list that company in that market called JSE. So if you go there with your company, which is unknown or a fly-by-night company, you are not allowed to sell shares though, because they are protecting investors. They know that investors may lose their money because your company is a fly-by-night. Also, it encourages short-term investment. You can invest for less than 12 months, or you can invest for more than 12 months. It is up to you. Right, then it also facilitates electronic trading of shares, where you can buy your shares online. Then you must remember the meaning of this STRAT, which simply means share trading totally electronic. S stands for shares. TRA stands for trading. Then T stands for totally. Then E, electronic. So we are saying trading totally electronic. Nowadays, because of technology, there is no need for you to go to JSE or to physically go to JSE. You can buy your shares online. You can sell your shares online because they are having this facility which relates to buying and selling of shares online. Right, thank you. We may move to the next slide. If you don't have questions, please ask questions before I move to the next slide. Questions about the functions of JSE. You can unmute and ask, or you can use your chat box.
Evening, sir. Sir, Mr. Ndlovu, can you hear me? So,
Okay, so if there are no questions, allow me to move to the next slide. Right, the next slide, we are focusing on the factors that should be considered when making investment decision. Remember that when you are intending to invest, you must consider the following factors. You must consider the following factors. Let's say today you are having 1 billion or 1 million, whatever amount you are having. Before you invest, consider the following factors. One, you must consider the return of investment. How much will you get? Does this form of investment allow you to get high returns? For example, we've got two types of shares, ordinary shares and preference shares. You may decide to buy ordinary shares because they are having high returns. And you may not buy preference shares because they have got fixed returns. So in this situation, this factor is influencing you to buy ordinary shares because you want to earn high dividends, which are your returns. So before you invest, consider the level of return on investment. Is it high or low? Then the next factor to be considered is the risk, level of risk. Risk can be high or low. I will use also shares, ordinary shares and preference shares. Ordinary shares are having high risk, while preference shares are having low risk. Take note of that. So before you invest, you may ask yourself, am I prepared to face high risk? If you are prepared to face high risk, you may buy ordinary shares because you want high returns. Or if you fear risk, you may buy preference shares because preference shares are having low risk. Consider that. And always, always remember that high risk is associated with high returns. Low risk is associated with low returns. If you are someone who does not fear risk, you'll be always enjoying high returns. Then also we've got investment term, the duration of investment. The duration of investment can be short or it can be long term or short term. If you want to invest for a short term period, you may invest for less than 12 months. Or if you consider to invest for long term, you may invest for a period longer than 12 months. Then also inflation rate is another factor to be considered when making investment decisions. Inflation rate affects the value of your investment. Inflation rate affects the value of rand, meaning to say the buying power of rand may reduce while you are or during the time of your investment. What does it mean? It means you are losing money if the country is having or experiencing high inflation rate. So consider the inflation rate before you invest so that you may protect your investment. Then another factor to be considered is taxation. Remember, we pay tax. SARS will want you to pay tax as you are earning dividends. Those who are doing accounting, they know that the company will pay tax, then the shareholders also will have to pay tax. So shareholders are investors. They have to consider the amount of tax which they are supposed to pay. We always try to pay less tax. We will choose forms of investment which may not compel us to pay high tax. So please consider that factor before you invest, the level of taxation to be paid by the investor. But let's go to the last factor, which is liquidity. When we are talking about liquidity, we mean the ability of an investment to be converted into cash. Is it easy for your investment to be converted into cash? Can you convert your shares into cash easily? Can you convert your fixed property into cash easily? So we may want to invest maybe by opening a 32-day notice account than a fixed deposit account, because fixed deposit, you're not allowed to withdraw money maybe for 6 months or for 1 year, depending on the duration of your fixed deposit. But for 32-day notice account, you can give them a 32-day notice, then you get your money back. And also for shares, you may sell your shares anytime, any day through JSE, or you go to JSE and sell your shares. It means they are easily converted into cash. Unlike when you are selling fixed property as a form of investment, it will take time for you to sell your building, assuming that you're owning Carlton Center as your building and fixed property form of investment. Few people can afford to buy that building, and you can spend 2 years or 3 years advertising that building, which means it is having less, or it is less in terms of liquidity. While shares are having high rate of liquidity, they can be converted into cash easily. But let us move to the next slide, where we are now explaining these forms, or the explanation of investment decision. Right, the first one is return on investment. Okay, there's a question. Can we attend to this question? Bonolo is having a question. Say, does the ratios and their rules apply to business studies? Hence, we have liquidity ratio. Is it only ratio used in investment? Right, Bonolo, we are not talking about ratios here. Let me just go back. I know in your accounting, you have liquidity ratios. Here, we don't talk about ratios, but we talk about liquidity as a concept. The ability of you as an investor to convert your investment into cash. Is it easy for you to sell your building, then you get cash? That is liquidity. Remember, I once said the word liquidity means cash. Now, when we say liquidity, it's ability of you as an investor to convert an asset or to convert an investment into cash. So we want any form of investment, or we prefer any form of investment which is having high liquidity, because anytime we may want cash. For example, you are a shareholder, you are in need of cash. You can sell those shares and get your cash, because shares are having that nature of high liquidity. But if you're owning fixed property, which is a building, you may take years selling that building. Buildings or fixed property are less in terms of liquidity. It takes time for you to sell the building or the fixed property. It's unlike shares, which are always having readily available market. So the ratios, we don't study them in business. We don't have them in grade 12 in our syllabus. You only do them in accounting. I hope I've answered your question. But let us move to explanations of investment decision. We want to explain these investment decisions, starting with the return on investment. Return on investment. Return on investment, we are focusing on what you get after you have invested. You buy shares, what are you going to get? You get dividends. You open a fixed deposit account, what are you going to get? You get interest. Okay, so these are just examples of return on investment. So we are referring to the interest rates, dividends, capital growth, or any other form of return which you can get after you have invested. Even capital gain is another form of return on investment. Right, high risk investments yield high returns. As I said earlier on, high risk are associated with high returns. Ordinary shares are having high risk, therefore they have high returns. So if you want high returns, you must be in a position to face high risk also. Generally, there is a direct link between risk and return. As I said, whenever we are having high returns, we have high risk. Whenever we are having low returns, we are having low risk. For example, preference shares are regarded as shares with low risk, and also they are having fixed or low returns. The return should be expressed as net after tax. When you are considering your returns, you must first pay tax, then the remaining amount, that's what you may regard it as your return because you have paid tax. Tax reduces your returns. Therefore, consider returns after you have paid tax. Then returns can be in form of capital gains. The capital gain can be obtained from someone who has invested under fixed property. If maybe Prince Okonko decided to buy building or fixed property. He bought that fixed property, 1 million, that is the price. After 1 year, that fixed property will appreciate. That fixed property will appreciate in terms of value. After it had appreciated, he will sell it maybe 1.2. So the difference between the buying price and selling price, we will regard it as capital gain. We'll regard it as capital gain. Right? There's someone who is struggling to join here. Prince Okonko, I don't know why he's struggling to join. Anyone, we can tell him to leave the link and rejoin. Maybe it can allow him to exit and try to rejoin again, because he seemed to be struggling to join the group, to join the teams. Okay, let us continue with our lesson. Risk is our factor number 2. Risk can be low, it can be medium, it can be high. Risk can be low, it can be medium, it can be high, depending on the duration. Right, over a longer period of investment, if you decide to invest for more than 12 months, you are buying shares, the risk is going to be low or medium. Then remember that some shares have high risk, and also they are having higher potential to allow you to gain returns or high returns. For example, ordinary shares have high risk, and also they are allowing you to get high returns. Always remember that. Why are we saying ordinary shares are having the highest risk? because they are the last to be paid when we are paying dividends. Let's assume that Curo is paying dividends. They will first pay preference shares. Preference shares will receive their dividends first, then later they pay ordinary shares. So if the profits are very low, it means ordinary shares are going to get lower dividends or they may not get anything. Secondly, if the company is not having enough profit or the company is struggling financially, it is supposed to be dissolved, liquidated, or liquidated. It means they will liquidate the company, they will sell all the assets, then they will pay preference shares first, then they will consider ordinary shares later. So if funds are not enough, ordinary shares are not going to get anything. That is the risk which is associated with ordinary shares. They are the last to be paid. Whether they are being paid dividends or the company is being liquidated, they are the last to be paid. That is why we say they have high risk. So do not just buy ordinary shares without knowing that you are the last to be paid in terms of whether dividends or you are being paid back your money because the company is being liquidated. Preference shares have lower risk. Why? Because they have what we call preferential claims. They claim first if the company is going to be liquidated, it is going to be the first, or they are going to be the first. They are going to be paid first before ordinary shares. They receive their money before ordinary shares. The company will compensate them before ordinary shares. What am I saying? I'm saying they've got preferential claim. They claim their money before ordinary shares. Then the share prices are linked to the factors that the investors cannot control. For example, economic conditions. During 2020, prices of shares went down, depreciated, which means the investors were losing. And also, I don't remember the year exactly when Zuma reshuffled the parliament or the parliamentarians or the ministers. The JSE reported that the shares were depreciating, the value of rand depreciated. Those risks are beyond the control of the investor. If the share prices are depreciating, you just observe and you don't have control. The only thing that you can do, you can sell shares and buy other forms of investment which are less risky. Then another risk factor is that share prices are volatile. It means they fluctuate, they are unstable, they are unpredictable. Today, the share price of Curo may be high, tomorrow they may be low. The share price of FNB may be high, tomorrow they may be low. The prices are not stable. They are being affected by political factors. They are being affected by so many factors. So many political decisions being done by our presidents, they affect the prices of shares. Always remember that. Within an hour, within some minutes, shares may change. The prices of shares may change. So that is the risk which is associated with different forms of investment. However, fixed property is having very low risk. Remember, those who are doing accounting in your grade 12, your teacher taught you that in accounting, buildings appreciate in terms of value. It means even if the economy is going down, the value of your fixed property goes up, which means you are not losing. So fixed property are having less risk. But let's move to the next slide where we are focusing on investment period as a factor which influences investment decision. So here there are two situations. It's either you want to invest for a short term or long term. So this is the duration of your investment, short or long term. The longer the investment period, the higher the returns. It means if you open a fixed deposit account for 5 years, you get high returns. But if someone opens a fixed deposit account for only 6 months, you also get less returns. So the investment period depends on your personal needs. Will you need cash or will you need money within a short period of time? If yes, you have to invest for a short period of time. If you're not going to be in need of money or cash in any near future, you can invest for long-term period. So short-term investment enable investors to have access to their money within a short period of time. You invest for 6 months. After 6 months, you get your money back plus returns or plus interest. The investment period can be short, can be medium, can be long term. Then let's talk about inflation rate. Inflation rate, we mean the rate at which the prices are increasing, a general increase in price level. We all know, or maybe you have heard about the history of Germany during World War I or World War II. They experienced a high rate of inflation. Also, Zimbabwe experienced a high rate of inflation, whereby the purchasing power of their currency was decreasing rapidly or persistently. So what does it mean? It means an investor who has opened a fixed deposit account, your money in your bank account may lose value. Within a short period of time, you have been affected by the risk. I'll give you also one example whereby around late 90s, we used to buy a fat cake, that is a guinya. We used to buy a guinya or fat cake 10 cents. Because of inflation, now we buy the same product, which is a fat cake or guinya, 1 rand. That is an example of inflation whereby the prices are increasing persistently or rapidly. So someone who kept his or her 1 rand in his house, today he's still having that 1 rand. He's now buying less products. He's now buying 1 guinya, but before he used to buy 10 magwinya or 10 fat cakes with that 1 rand because 1 rand was having value or the purchasing power of that rand was high. It is unfortunate that now the purchasing power decreased. It is now low. That is why we buy less. So when you are investing, check the inflation rate. Are you going to earn returns, that is high interest rate, which are maybe more than inflation rate? If our inflation rate is 5% or 6%, your returns or interest rates must be maybe 10% or 12%, so that your returns may outperform or may allow you to earn more than what you are losing. Right? Inflation has a positive effect on investments such as property. As I said earlier on, that property or fixed property, they appreciate in value. So if the inflation rate is high, the prices are increasing. Also, the building or the fixed property will be increasing in terms of prices. So you are gaining as an investor. Then shares also may increase in terms of prices. As the price of shares are increasing, the investor gains because maybe next year when he decides to sell shares, he can sell them at a higher price. So the inflation will put that investor at an advantage. Let us go to liquidity. I explained this liquidity. I will explain it again. An amount invested in a type of investment may or can easily be converted into cash. For example, you invested 1 million buying shares. You are now owning shares. You can convert those shares into cash by selling them. We call that liquidity. Is it easy for you to sell shares and convert them into cash? If yes, shares are having high liquidity. But if it's hard, shares will be having less liquidity. Then it is used to describe the ease and the speed with which investors can convert their investment into cash. Is it easy for you to sell your fixed property, to sell that building, Carlton Center as your building? can you sell it as if you are selling shares? The answer is no. Fixed property does not have high liquidity because few people can buy fixed property. It is expensive, right? An example is that an investment in a savings account, unit trust, will be easier to convert into cash. You can go to the bank and fill some few forms and get your cash back if you're having unit trust account or savings account. But if you are having fixed deposit for 6 months or for 1 year, you are not allowed to withdraw your money for that period of 2 years. So it means fixed deposit is having less liquidity compared to savings account. Then taxation is a factor to be considered when you are intending to invest. A good investment will give good after-tax returns. It means after you have paid tax, you still have or you are still remaining with high returns. Then income tax implications are supposed to be considered when investing because you pay tax. We regard dividends as your income. So you must pay tax after receiving your dividends. You have to consider how much are you going to pay in form of tax. Right, any questions before I move to the next slide? Any questions before I move to the next slide? You may type or you may unmute, then you can ask. Okay, let us move to the next slide. Now we'll focus on what we call investment opportunities. Where can you invest? You can take your money and invest maybe what we call mutual funds or stokvel. This is popular in our area or residential areas. People are always involved in stokvels or mutual funds. Then the second investment opportunity is managed portfolio. The third one is 32-day notice account. And then the other one, it's debentures. Those who are doing accounting, I think they have been doing this debentures or they are yet to do it. And then business ventures or venture capital. We covered this concept in grade 11 last year, if you still remember. Then the sixth investment opportunity is called endowment or life insurance policies or retirement annuities. These three investment opportunities, we treat them as one, though they are different. The endowment policy, life insurance policy, or retirement annuity. They serve the same purpose. However, in this topic, we will discuss about them as one form or one type of an investment opportunity. So always remember that we have got 6 types of investment opportunity. Let's go to the explanations. Right, the mutual funds or stokvel, we regard them as an informal saving scheme. We regard them as an informal saving scheme. They are not formal. They are not being regulated by the law. So you are saving in an informal, whereby a group of people may contribute money monthly or weekly, depending on their agreement. Then each member takes a turn to withdraw or to get money from the scheme so that they may gain or enjoy the personal gain. Take note of this. Under stokvel, there is no return or there are no returns. Or if returns are there, they are very small. It is a way of encouraging people to save money each and every month. It is just an informal way where people encourage each other to save money for future expenditures or certain maybe expenditures where they are intending to buy in bulk, so they may save money through stokvel. Right, let us move to the next point. Under stokvel or mutual funds, banking fees are shared by members, meaning to say, as we will be contributing each and every month in our bank account for mutual funds, if the bank is charging us the fees, we share them as a group. Then in times when it is hard for us to get loans from the bank, stokvel payouts may help us to buy in bulk. For example, you are intending to buy a car or you are intending to buy a fixed asset. Stokvel may assist you to buy that instead of going to the bank and get a loan. And stokvel are usually managed by a trustworthy chairperson or treasurer. We can't just nominate any person to manage that, because they will end up disappearing with our money. So that person called chairman or chairperson may be having responsibilities of keeping records, managing the bank account. Then the members usually discuss how money will be invested or how money will be distributed. Someone may argue and say stokvel or mutual funds cannot be regarded, or we are not supposed to regard it as an investment. Yes, it may not sound as an investment because sometimes there are no returns. There are no returns at all. Or if returns are there, they are very low. So it's not a good form of investment, but it is a way of saving money as a group. But in your examination, you have to consider this mutual fund or stokvel as a type of investment opportunity. Let's talk about the risk. Right, the risk may be high. We have got scammers who claim to be running stokvel. Some time ago, it's a few years back, we once had the WhatsApp stokvel. So many people lost their money under WhatsApp stokvel. And people were using WhatsApp to scam people. They create a WhatsApp group and they just post the link so that people join and become part of the stokvel. So other people also run what we call pyramid scheme in form of stokvel. When you have contributed money, they disappear with your money. And also another risk, money in a savings account is a safe investment, but it is having low interest and low returns, which means you are not benefiting that much. Right, let us move to the next slide, where we are talking about managed portfolio. Managed portfolio, we are referring to a group of investment or a group of type of investment. A portfolio is a basket of investment, not literally a basket, but a group or a number of investment. For example, one investor may be having shares or may be owning shares, also fixed property or shares in different companies. If I may say, if Prince is owning shares from Curo, having other shares from Standard Bank, other shares from FNB, and other shares from Coca-Cola Company, what does it mean? It means that he is having a basket of different types of shares. He can't be in a position to manage all those types of shares. He must employ or get a financial advisor who will be advising him on what to do as he's having different types of shares or different types of investment. So we'll say Prince is having a portfolio of investment. Within that portfolio, Prince is having different types of shares. Right? Prince will go to a financial institution. He can go to Clientele, he can go to Capitec and instruct Capitec to manage his shares, to manage his fixed property. All types of investment owned by Prince are going to be managed by the bank. Then Prince will be paying the bank, or he can employ a financial advisor who is responsible for managing all those types of investment owned by Prince. So if the portfolio does not perform well, if shares are not performing well, Prince is owning shares in Standard Bank and they're not performing well, that investment advisor or financial institution can change or can sell those shares and buy shares from BMW. He will be doing that, or that bank will be doing that on behalf of Prince, because Prince employed that financial advisor or instructed the bank to manage those types of investment. So whenever we talk about managed portfolio, think about a number of types of investment owned by one person. A person may be owning different types of shares from different companies or from 5 companies. Then he can't manage all those investment. There is a need for him to instruct the bank or the financial institution to manage that on behalf of him, or to employ a financial advisor to manage that portfolio. And the financial advisor will be always monitoring the performance of shares. If they're not performing well, that financial advisor can sell them and buy from a company which is performing well. If that company is no longer performing well, BMW does not perform very well, they can sell shares. Then they buy from Toyota. Right? In terms of risk is lower over a longer term period. Risk is lower. Why are we saying risk is lower? Because we have a portfolio manager who is responsible for managing the risk, for changing the form of investment or the type of investment if it is no longer performing well. If shares are no longer yielding or giving dividends very well, they can sell them, they go and buy from a better performing company. That is why we are saying the risk is low. The risk is low. Right? And investments are made in various sectors. For example, your portfolio will be having different shares from different sectors, from primary sector, from secondary sector, from tertiary sector. You can invest in different companies. Therefore, in that situation, it means you are not placing your eggs in one basket. Your eggs are not in one basket, so the risk can't affect you. You are spreading the risk, and the portfolio manager is there to manage that risk. Then money is usually invested in capital market, and unforeseen circumstances may impact negatively on the value of portfolio. That is why we still have high risk in a short term, but over a long term, we may not have risk, or it may be low. Right? Any questions? Any questions? No questions? We are about to end our lesson. Let me finish up. I'm left with a few slides which I will explain. Right, we have another type of investment called 32-day notice account. This is just a bank account whereby you are not allowed to withdraw your money up until you give a notice of 32 days. If Emihle is having that 32-day notice account with Capitec, if she is intending to withdraw money, she must go today and give a notice that after 32 days, I will come and withdraw money. Why are they doing that? They are trying to discourage you from withdrawing money so that you may earn interest. If you withdraw money, it means you can't earn interest. But if you keep your money for a longer period of time, you can earn interest. So what are we saying? We are saying money is invested at a fixed rate, although withdrawals may be made, provided the bank is given how many days? 32 days notice of the withdrawal. In this type of investment, it earns more interest than an ordinary current account, check account, or savings account. Why do you earn more interest? Because you don't just withdraw your money. But this 32-day notice account, it is having less interest when we compare it to fixed deposit account. Let us talk about the risk of this notice or 32-day notice account. The risk is low. Why? Because as you are investing, you will get your money back plus interest. If you invested 20,000 for 1 year or 2 years, after 1 year, you get your money back plus interest. And interest is calculated on the daily balance. Then interest rate may fluctuate with market conditions. Right, then let's talk about debentures. What is a debenture? A debenture is a type of investment which is issued to raise borrowed capital from the public. Those who are doing accounting, I think your teacher taught you that a debenture is a long-term loan. Yes, it is correct in that sense. Then here in business studies, we treat this as a type of investment which is issued to raise borrowed capital. Then the lender is called a debenture holder. Being a debenture holder, it means you have agreed to lend money to a company. You have given that company or you have given Curo 1 million. So you are a debenture holder. Curo will take that 1 million and use it to expand. Then they pay you interest. Debenture holders are creditors. They are simple money lenders. They are not shareholders. So do not confuse a debenture and a shareholder. A debenture holder is a money lender. A shareholder is a part owner of the company. So we are saying the company is liable to repay the amount of the debentures because it is a long-term loan. Most type of debentures can be traded on JSE. You can go to JSE if you're having 1 million, then you give it to companies or public companies in form of long-term loan. You have invested your money, then they pay you interest. Debenture holders, they receive annual interest. They don't get dividends because they are not shareholders. They get interest. The risk associated with debentures is that they have low risk because the interest must be paid and the loan will be paid back. Companies are liable to repay that 1 million or that long-term loan, which is in form of debenture, plus interest. That is why we say the risk is low and the interest is usually fixed. Investor earn a steady income in form of interest. Right, for today, we will end on debentures as our last slide. Any questions? If you're having a question, you may ask before we end our lesson. You can unmute and ask your question. Or you can use the chat box to ask. All right, if you don't have questions, thank you. We will continue on the other day from this slide to the last part of our topic.